Okay, so today we're gonna talk about stock markets and our myths, and it's inspired by Charlie. And we'll talk about uh, like what do we think and what really happens, right? Right. Um, so again, going back, I run this website called sec.com. I'm a software engineer by trade, and I also do a masterclass with Gaganji, who is another wonderful friend of mine. Um, so in the next 30 to 40 minutes, whatever we talk, feel free to stop me, be comfortable, share what you feel. This is more of a learning session. We all want to help each other. Okay. Um, Remember, I'm not an expert. Whatever I'm presenting today, it's not what I am showing it to you. It's someone's wonderful work. I'm just copying it. I'm just sharing whatever I feel are some wonderful, interesting bits that I've seen across the places, and uh, and and that could be helpful to you. Okay. Now again, going just a reference. This is the website. This is how it looks like. And the reason I started Essay Divers was simple. I wanted to buy stocks, but the biggest problem was I was not following the process every time, and I wanted something to make sure I'm doing diligently the same process every time before buying something. And so that's my drive to start it. If once you visit it, if any of that probably connects with you, do let me know. Do share your feelings with me, right? This is how we lay out the page. So for any stock that you would like to see, we'll show you the fair value estimate. And there's a caveat here. One thing that we show is we are 1 year old, and the reason I purposely keep it 1 year old is that way, we can predict what's happening today, right? So we can see whether based on previous history are we able to predict today's prices, right? Make sense? And just remember that today's revenues and today's profits for good companies will be higher, so the valuation will be much more than what you're seeing here, right? Right, make sense? So that's what I want you to remember every time. And disclaimer, whatever we discussed today, not a bias recommendation. I am not a financial advisor. All the examples that I'll talk about are just examples that I've learned, right? And just take it as it is. Do your due diligence, understand what you're doing. A buy for me may not be buy for you. A buy for me for 10 years may be a buy for you for 1 month. A buy for me for 1 month may be a buy for you for 10 years. It's all different, okay? So please understand that. And there's something I really found on the websites, on Google, so I really liked it. And so this is, अरे भाई मेरी जिम्मेदारी बनती है तुझे चेतावनी की. So that's what I'm doing, okay? There's a good chance you lose money, so be careful, okay? And as I said, my goal is not to lose money, and we're going to talk about the process. So here's my philosophy in short, right? Like the first number one rule I have is risk management. No, I don't want to lose my capital regardless of what happens. I lost my capital through options, right? In the past, through bad companies. And one of my goals is not to lose money regardless, right? Right. And the way that I've learned, following wonderful investors, like if you buy quality companies, right, you're gonna make you're gonna make your money, and the upside will take care of it. And if you look at any company, and the question that you should ask before buying a company is, this company will this company stand will this company stand a test of time, and can I see this company being there for the next 10 years? If you think this company is there for the next 10 years, then only buy it. So that's my first test. So going to uh, Pradeepji's point, right? Starbucks, why I also looked at Starbucks. Yeah, it's a company that I feel could be there for the next 10 years. Yeah, Pradeepji had a question.
Yep. Sometime it happens that business what is today may not be tomorrow. For example, Yahoo. So it was pretty good in 2001, but I think by 2010 it was gone or something like that, very, very low. So uh, in a good faith, yes, it will be there. 95% chances it will be there, but 5% chances there could be disruption. Nokia, one of them, or Motorola is another. So all these companies. So it's very difficult to say anything definitely is going to be 10 years, but yes, 90% chance could be there. It will be there.
Yes. So as I said, if you feel there's a chance that it can go away, I would not buy it. So it's a personal belief, I would say, Pradeep. So for me, I would choose companies that have been there historically for the last 10 years, and that's why I believe they will be there for the next 10 years. Make sense? Or 100 years, whatever, right? So I'm looking more for longevity from a historical side.
Okay.
It's a very special uh, I forgot the word, but it says the older the book it is, that means more better the book is, right? Like the principles have stood the test of time, right? And I don't know if you know, like building a business is very hard, and then being in the business for 50 years is much more harder because you have so much capital coming in, right? So much capitalistic forces against you, right? And you're surviving, right? You're surviving recessions, you're surviving COVID and whatnot, right? You're surviving world wars, right? So that shows the struggle that the company has made to have that fortitude, right? And that's one of the reasons I'm thinking like the historical patterns will tell us that this company is gonna be there or not. Now the biggest challenge is like what price to pay and is it a growth company. So the second big point for me is the company growing? That's very important. If the company is stagnating like triple M or something, then I may not buy it even though it's cheap. Make sense? So I want to ensure that the company is growing, and we'll talk about some examples as we go. Okay, and it should be growing. Okay. And again, the most important thing is price. At the end of the day, let's say you have a house in Snoqualmie which is like $1 million, but someone is paying $10 million. That's just a crazy price to give. So everything is value at some price and crazy expensive at some price, right? So even though it's quality, so you have to be careful. And the third thing, which is what I'm trying to inculcate in my process, like, okay, I bought this good company. I believe it has a good runway. Now, but every year we need to check on that, right? So as you talk about Yahoo, right? You could, if you do those health checkups, you'll realize that Yahoo is losing momentum, right? Once you do those quarterly health check, right? Like we do a health checkups to a doctor, right? You'll realize that as you keep doing it, the company is stagnating, right? And the number of customers are leaving or something is happening. So there's a good chance for you to cut that investment down and convert it to something else, right? Make sense, Pradeep ji?
Yes.
Again, and do nothing, like, because you're evaluating your companies every year or every quarter, they're growing. So why to spend your time on wasting on something else, right? Let's do wonderful work. Let's sleep well. Let's have fun. Let's spend time with the family, right? Let's do what we like, right? And we this is not our primary job, right? This is not. So we have our jobs, right? So our goal is to minimize the work that we put on it, but also to use some time to make sure we earn a little bit extra, right? That's the idea. So process matters, as I said, right? So there are certain ways by which I find my candidate companies. So I just wrote them down. Uh, Take a look. But I think like the biggest thing that I've learned over the last 12 plus years is when there's a big fall, that's the right time to buy. And that's when you need to have your list ready. Okay. If you have your list ready, you know how to fill your bags, right? Okay. So remember the goal, do not lose money. That's the goal. Okay. Always. Um,
One more question I have, Chandanji, on the same line. So you said whenever the market is going down, it's a good time to buy. Again, there could be a confusion. It is going down. How deep it will go? I mean, how low it will go, and how will I know how low it is going to be?
Yeah, I think wonderful question. I always, the short answer is I don't know, Pradeep ji. That's the real answer. Yeah, because things that can go cheaper that are cheap can become cheaper, and things that are crazy can become crazier, right? So you never know. I think the only thing you should know is like if you, let's say, take a business and you know that business is growing, but currently its value, let's say, the property prices are in Snowcom is $1 million, and suddenly the building is going for 500K, right? It can go
Mhm.
further 300K, but you don't know when the markets will turn back, right? So
Right.
it might be a good opportunity to buy it because you're getting a 50% discount, right? So if you can calculate that value, it will help you get that cushion. Now, like, should I buy 100 stocks? Let's say you have a pool of $100,000. Should I buy that full 100K dollars in that stock? That's where we need to navigate. Maybe I can start with 1% of that amount and start building a position slowly, right? And reach 5%. Make sense? So
Yeah.
there are these things that you can think of, but you never know. And bottom is very hard. For me, luckily, I was able to time to 2020. I was able to time November 2022, and I was able to time October 2023. So
Okay. Great.
the way you need to do is you need to buy when it's low, and so you need to have that list ready, right? You need to know what value the price is coming, and you should buy that companies. Right? Yeah. Again, these were some of the last sessions we did. So I would encourage you everyone to go look at the videos. Uh, that will again help you what philosophy I'm trying to convey. And everyone's philosophy is different. You can have your own philosophy, and please don't copy my philosophy. You need to have conviction on your philosophy. At the end of the day, you need to hold that stock, right? So make sure you understand what scares you, what makes you stand down and what makes you give up, right? And growing bull market is good, but like we are as investors, we are tested during the bear markets, right? That's where the key is, right? So again, like last two sessions, just a quick recap. What we the biggest learning, if you have to recap from the first session is stock is not a paper, it's ownership. It's ownership of the business, right? That's the most important learning if you want to take. And the key thing we have to buy is we have to buy it at a margin of safety. And the way to determine margin of safety is figure out the floor price for the stock. And if it comes to that floor price, start chipping in, right? Make sense? And in the second video that we talked about our moods, right? Like if we see red color, we get scared, right? If we see green color, okay, we are happy. So we just need to think from a contrarian perspective. But the biggest problem is we don't know, we are going against the markets, right? When we are buying a stock, someone is selling it, right? Make sense? So that means someone has some information that says it's a sell decision for them, but for it's a buy decision. So we need to be humble enough to understand why is he selling it. So we need to really know it. And there are some situations where someone sells it. So I'll talk about some situations like someone may be forced to sell. So there are times when a stock gets added to index. By the way, whatever I'm saying right now, those situations are gone. The market is pretty now amazing at that. So like 10 years, 20 years back, this situation used to arise. Like so a stock gets added to the index, then most of the index fund have to buy that stock, right? And if no one is selling, the index funds, because they have to maintain that percent, they'll keep buying, right? So they have to bid up, right? To so that someone sells, right? Make sense? And hence you'll get increase in price. So same thing when a stock is removed from the index, now the index has to sell. Now, if the index companies have to sell, someone has to buy it. So if no one's buying, the index will they will keep dropping the prices, and that's how you'll sell. So as long as it's a forced arbitrage, it's a wonderful situation for us to buy. Make sense? So those are some examples that might be that might you we may need to understand better. Okay, so going against the current is not easy. It takes a lot of courage, but it's very rewarding if you do your homework. Okay, so this is a wonderful slide. I would encourage everyone to understand this. So if you're looking for 8 to 10% return, I would say just invest in index funds. Again, very like low fees. Like I've given some examples: VO, left, VFAX. Someone had asked me the example, so do revisit them. They are the most cheap, call it like most cost-effective funds, and they will always guarantee you market returns, right? Which is like for the last 20 years, it has been always like 8% plus, right? If you want a 1% better in return, I would say I would go with Berkshire, or there's Merkle, which is a wonderful company run by Thomas Gainer, or there are a lot of super investors, which we'll talk later. They have been beating my market index by at least 2 to 3 crazy, points, right? So you can go and buy their mutual funds, right? But they charge fees, right? So you have to understand how much fees they charge, right? And then the third path which I'm taking is buying wonderful companies, because all these good investors are buying. So what I need to do is just make sure get their list and do my own crazy calculation on top of that, and then just make a buy, right? So that's what I'm doing. And the last is like gambling and speculating and trading, where you can make a hell lot of money, but you can make it zero also. So I am not taking that part, but these are the options that I know. And I'm pretty sure there are a lot of other options. But if you don't want to do any work and you want to get, if you know you have next 30 years ahead, and you don't do any work, passive investing is the way to go. Okay. uh, yeah, Ashiji, please tell me.
This in Berkshire, why are you listing low to no stress as a con?
Yeah, so sorry, it should be a pro. That's a bad thing.
I was just like, maybe I got it wrong.
Thanks for that.
No problem.
Thank you, Ashiji. That's a very
Hey, Chandan.
yes, Karthikji.
Hey, Chandanji. So I have a question. I mean, this just as a novice person, I have this question. So basically, let's say someone who's been investing for several decades, right? They saw a sharp dip in 2020, then it all spiked in 2021 or 2022, whatever the time windows. Again, in October 2022, it took a sharp dip, and now again it's going all time high, right? I do understand like it's a long term game, but what if somebody like you were telling earlier, that if you time it well and you like sell and buy every 2 years or something, based on the just last 3-4 years of history, I'm not taking a longer thing because that's my limited knowledge there. So what is your perspective on that?
Probably I didn't understand your question well, Karthikji, but like what I'm trying to tell is I'm not selling and buying. I'm just holding it.
Okay, so whether the market goes down or not, it is immaterial for you. You just keep holding it and you are playing it long.
Yeah, I think like if you go back to the first presentation, right? If a business is earning 20% every year, right? If it continues to earn 20%, right? Why need to sell it, right? It doesn't matter what
Got
the
it.
price is, right? The business is earning every year 20%, right? And it continues to earn 20%. It's a wonderful business for us, right?
Right. Yeah.
Right.
I
So
mean,
price is just a reflection of whatever people's thinking of it, right? But if the business continue to earn every year 20% compounded, we have made the right decision, right? So if you see, right, markets will come back, right?
mhm,
If you take a long term record, like more than 5 years, you will see price of the stock follows the earnings.
got it. Okay.
Yeah. Okay, Ashish, please tell me.
Okay, I have two questions. They're connected. So the first one is, would you always consider or give preference to a passive index funding over investing in a CD? Right. That's the first question. The second question is, if so, um, what's your strategy for passive index funding investing? Do you do like dollar cost average, uh, irrespective of the price of, let's say, VO or VFAIX, or would you like still wait for and time it, relatively speaking, right? Um,
So I think the first question is CD versus passive investing. Is that correct?
yeah.
So CDs are giving us less than 5%, correct, Ashiji? Is that correct right
Yes.
now?
Yes.
So the
It's like
question,
5%, let's say, give or take.
the passive indexing is beating a CD, right? So why would you invest in CDs?
No,
I
So you
think
but
said you will not invest in CD, is what you're saying.
No, so again, like we are talking 10 years ahead, right? Makes sense, Ashiji? So we know the compounding will be 8%, right? Every year, right? For index passive, right? Like as
Right.
long as, so okay, I think let's preface the context. Before we invest, right? We need to figure out what amount we want to invest and do we need that amount for the next 5 years or 10
Mhm.
years, right? If we don't need, then only we should invest. That's the first rule. I think we didn't talk about that, but I'm just want to say that only put money that you feel you will not need for the next 5+ years. Okay, that's the
Right.
first condition. Right? So if you don't need that money for the next 5 years, let's assume that, right? Would you prefer 8% return or would you prefer a 5% return?
I think the answer is obvious, right? Like,
Yeah. Right.
uh,
Right.
I
Fair
mean,
enough.
CDs
So
won't even give you 5%, maybe beyond this year, because the
exactly.
interest.
No, you can get it, but if you can buy a 10 years treasury, so you can get it. But I'm trying to say, like, maybe in the next presentation, I have one slide where Warren Buffett was getting 21% return from CD. How much? 21%. But he still bought stocks. So
Okay.
wonderful example how Warren Buffett thinks. So we'll talk about that. And I think I covered why we would prefer like a growing yield versus a fixed yield in our first video.
Right.
Yeah, I think we
What
talked.
about the second question, which is, when do you go into um, even buying these kind of ETFs, index funds? Like, do you still try to time it, or some people say don't think, every month, like, keep putting some, and it will average out over time, right? Both could be winning strategies, but I just wanted to ask your opinion, right, or your suggestion.
To be very frank, Ashiji, even I don't have opinion on that. Uh, for me, I feel like I don't. Again, you missed the first session, Ashiji, but in the very first session, we showed a slide wherein there were all the top good companies, and each of them, if you look at the 52-week and 52-week low and 52-week high, there was a 50% split. So essentially, if you are a wonderful investor, if you can time it, you can earn 50%.
Mhm.
So you just need to know, right? So that's the catch, right? So I personally feel I don't want to, right? Because I think I can do better. Makes sense? But it all
Okay.
depends on your effort here, right? Makes sense?
Mhm.
Like as I said, like Cigna fell down 10%, right? Nitinji knows, right? Now it's up 16%, right? Right? So it depends, right? Hershey's fell down like to 180. Now it's like 190 or 187, right? So it depends.
Mhm.
Again, all these examples I'm trying to say are not like indications, but what I'm trying to say is you need to know at what point you need to buy. and when it's a wonderful investment. So VO could like VO and V5X. The only thing wonderful thing about like buying indexes, like if the market falls, you don't feel bad because everyone's losing, so you're fine.
Right, right,
So it's more of a like a behavior
That-
perception there, right? Makes sense. But if
right,
market grows and your stock doesn't do well, then you feel really bad, right? Makes sense.
right.
And that's the challenge we need to fight against. And that's why we need to do the health checkup, right? I was talking about, right? Okay, Rahulji, you had a question.
Hey Chandanji, yeah, I have a question not related to index fund, but just in the long term, like the 10-year thing, right? So let's say, uh, let's say I buy a stock, I really believe in the company. You cannot like predict the future, right? Like regardless of your studies that you have done for that business, let's say 5, 7, 5, 6 years down the road, you realize that it is not moving. And I have a couple of example, let's say Intel, right? Like the 6, 7 years, the stock is not moving. And I know like the next 5 years, what the vision of the company is. Do you like still in that case, like what should be the, you know, like the going forward strategy? Uh,
I really like that question, Rahulji. I was in the Intel board, so I know what you mean. And I think again, see the first video, and you'll learn something called as like management ownership, skin in the game, and you'll realize why Intel may not perform well. I mean that time, and why it may. I mean, future is uncertain. We don't know,
right.
but
Right.
like there's some tailwind against Intel that can help it. But again, it depends on. It became lazy basically. It had a non-tech CFO, whatever, like CEO leading, right? So there are certain things it took for granted, I guess, right? We don't know the future right now. Maybe let's stop specific stocks because each stock has its own story. It will be harder for me to justify, and we can have another conversation for that, Rahulji, right? But I also in the same boat, but I learned Intel is not a quality company after some time.
Yeah, but I was just taking an example, right? So at that point, like, would you like reevaluate and like,
Yeah,
and let's say if I know if I
my-
can use those funds in a
Yeah.
in a company that I have done, enough study that
Yeah.
it will probably do better, like, because you're talking about like long term, right? Just forget about it. But in a situation like this, I'm not like really sure. At least I don't have a good mental model to really understand like what to do.
So just a quick data point. Intel went to $24 and now it's at 48, 49, 50, right? Somewhere. So double actually in some way. So you never know. Things can come back to its
Mm.
right side. But yeah, it's still behind its like previous like 5-year numbers, right? So
Mm,
it's still
mm.
not compounded from that perspective. So you need to know what time to buy. It's very important. You need to do that study of that quality and the growth rate. So if you look at the ROIC numbers, they were falling for Intel. It's just I saw it later. Make sense?
Mhm.
Until
Right.
then, I was not good at it, right? Make sense?
Right.
So
Yeah.
we will talk about that, okay?
Okay.
Let's move to the next slide and we'll come to all the questions later, okay? 1 second, okay? I just want to make sure we make progress also, okay? So, and the reason why I'm trying to tell you like the second part, which is like buying Berkshire or Markel or any of those wonderful investors, if you look at all these investors, right, in this list, right, they have all beaten the market for n number of years and by so much percentage, right? So if you look at like Joel Greenblatt, he has done it for 20 years for 30% CAGR, right? And Walter Scott has done for like, it says 9% a year, but I think it's more than that, I'm pretty sure. Warren Buffett is like 14%, right? 13%, right? Right? Soros, right? So, and I think if you can study them, it will be really helpful for us. That's what I'll say, right? Why I was telling Ashish ji to avoid funds, like especially other kinds of fund other than index fund, is the impact of fees. So here's a small chart. If you take 0.5% fee and if you take 1.5% fee, you lose like around like $90K, right? Do you see, Ashish ji? And I don't want to lose those $90K because I know I can do better. Make sense, Ashish ji?
Right,
So that's the idea.
right.
Right. Nothing. I think I can. I think I understand things. So I don't want to lose even that $90. For now, after I become old, I'm pretty sure I'm going to go index funds. When my mind doesn't work. So here's a question for everyone. I shared an Excel sheet. Probably if anyone of you can share that Excel sheet in the group chat again, that will be great. So what do you think were some of the best stocks for the last 30 years? Again, please type it in the chat box. That way we will have it. I'll share the Excel sheet in the group, and that way people can put it there also. Okay. So again, think for some of the top best stocks for the last 30 years. Okay. Again, don't be shy. Put whatever you think. Like Tesla is fine. Anything is fine. Okay. Please put it there. Okay. Is the speed at which I'm saying everything makes sense? Like everyone is able to understand what I'm trying to say, right? I'm assuming the quietness means good, right? Okay. Okay. Oh, wonderful. We are getting Nvidia, Apple, Microsoft. What else? Other people are not want to contribute? Arpana ji, Albert, Pradeep ji, Rahul. Please
I
add.
was trying to find where is the chat.
Oh, okay.
So
No worries.
Is this
yeah,
a
I'm
different
on
document?
phone.
Okay. You can say it, Pradeep ji. That's okay.
I think the document
Yeah, I
you
found
shared
it.
is different.
I found it. Okay.
Yeah. 1 second. Yeah, you should be able to add it, add your email and add it there in case. Okay. Yeah. Okay. So why don't we see the list? Everyone has done the homework, right? Okay. Let's see. What sectors do you think have performed amazing? Ah, Kadiji says Exxon Mobil. I love that. Yeah. I think right now it's a very cheap stock, by the way. I'm evaluating it. But I
Yeah,
don't
so
understand. I don't
I've put
understand. That's my problem. I'm still learning about it.
Yeah.
I was reading about Charlie Munger's buy of Belridge Oil, and man, he made like 20x in like 2 years or 3 years, and then
They
converted
also
as buy.
bought this other oil company recently, right? It starts with O. I forget the name.
Oxy.
Yeah, that
OXY.
Oxy thing.
Yeah, Warren Buffett, right? But yeah, that should fall. It's just Warren Buffett is buying. That's why it's not dropping. Every stock has dropped in the. But there's a lot of merger and acquisition going on, and if you look at all the mergers right now that's happening in the oil thing, they are all stock based. That was interesting. Anyways, so what sectors? Auto, tech, wonderful. Nitinji says tech. Okay, so why don't we see it, right? So here are some of the companies Lockheed Martin, that's a wonderful company again. So here are the top companies, right? Can we see how many tech names are here? And okay, are there some companies who people don't even know here? Are there some surprising names? So my suggestion would be, look at all these companies, spend some time understanding them and why they became successful. If you go like some of them, right, you understand some of the patterns that make them wonderful and that made them what they were and gave this wonderful returns, right? Like Master Beverage gave 30% CAGR, right? The last company introduced Frigidaire. It's a wonderful company. It's giving 24% CAGR, right, for the last whatever, like 30 years, right? So look at these companies, study them. One company I really want to talk about is Copart. Hopefully we can talk about this sometime later. But what it does is when our car goes bust, right? When a car gets totaled or something, insurance company basically instead of repairing the car, they sell it to Copart, and if Copart can sell it, the insurance company gives to Copart. Copart manages the selling of those cars, and they have only one competitor, so they are monopoly. They are almost a monopoly, and it's the best stock for I don't know how many years. You see, right? Yeah, it's a tech company in some way. It's across 70 plus countries, and it's just amazing. I never heard about it, but like last 4 years, I'm reading about it, right? And I had a chance to buy it. I didn't buy it. I felt so bad.
And then you will be sharing this link to the presentation, right?
I'll share that. Yes.
Okay.
Yeah. So again, these are the please look at these companies, and if you want to become a good investor, the only way you can become is like look at good companies, find why they became good, and see what patterns led them, and that will hopefully convert you to when you're looking at other companies, right? So you can match those patterns, right? That's the idea here, right? Again, hopefully there were a lot of surprises, right? One is like MO, which is Altria, which is like the uh, it's a sin stock, like all the cigarettes and all that, right?
Yeah.
Right.
I mean, it's a very good dividend stock too.
Oh, it is 10% dividend. Yeah. Hopefully people will not leave cigarettes. That's how the world works, right? Same with India ITC, right? So it's like that. Or DIG right now, which I'm looking at. Okay, mid two. So that was the first thing. Like we feel tech is the most booming sector, but actually it is not. There are these other companies who are growing regardless. By the way, I don't know if everyone knows, right? Do you know a company where we use every day that we are using at our home. We use it for paint.
Paint.
Burger paints. Have you ever heard about Burger paints?
Yeah.
Do you know Asian Paints is one of the hottest stock in India?
Yes.
Yeah. So likewise, there's one more company here. I would encourage everyone to look at that. It's one of the wonderful companies I want to buy sometime. And the reason is like there's no tech there. No one can do anything against that. Everyone has to paint the house in some time. And all the plumbers and all the people are like are made to buy from that company. It's such a wonderful company. And if you read the 10K, realize why the contractors prefer that company. It's such a, I mean, you try to bang your head. Why don't you think like that when you hear those stories? Anyways, so the second myth is options and futures make a lot of money. Yes, they do, and I'm pretty sure all of us would have made a lot of money here. And there are some memes on the web which I say, ना मैं समझा पाऊंगा ना आप समझा पाओगे कि कैसे लेना क्या करना. So I think you can make money, but there's no science behind it. It's just art, and it's like market timing, and you're against a lot of big shots. You never know what can happen. Someone can make 3 crores in one day and then lose 5 crores the next day, right? You never know what can happen, right? So the reason I don't play it, I used to do it, was doing safely only. But what I've learned is like basically stock is a zero-sum game, right? When someone is buying, someone is selling, right? Make sense? Is that everyone understands that? So the only way you make money is when the companies make money, because the companies will produce dividends, they'll produce products, and those products will sell in the market, and that's why I'm making money. And that's what I'm betting on, right? I'm betting on companies making money. I'm not betting on someone losing money and I making money, right? Then it's a zero-sum game. So the only person who makes money in that board of that transaction of stock is, can you guess who makes money in the overall process? Well, the answer was there, by the way.
Broker.
Right?
Broker.
Yeah, brokerage, they make a hell lot of money, and that's why those are one of the good stocks to buy. And just another area that you may want to. That's why Robinhood is investing. Like all the big shots, Silicon Valley is going after investing money in Robinhood and the other kinds of all these funds, right? Do you know how much were the profits from for Zerodha for the last year? Anyone want to make a guess?
I saw the numbers few
Shit.
days back. I don't remember, but somewhere it was. Let me take a guess. Somewhere around 600 crores or something.
Yeah, it's 3,000 crores, my friend.
3,000. Okay.
And that too on the revenues of 6,500 crores. So 50% profit, less than close to 40% profits. Right? So I would say look at profits of any brokerage and you know how they make money now, right? So by selling your options and futures, that's how they make money. So we are losing money. That's what I'll say in this battle of options and futures. So be careful. I mean, if you have something successful, yes, please go ahead. But and here's a wonderful quote. Hopefully you can internalize it. Like, Rome was not built in a day. It took time to grow that money, right? In the money terms, right? But destroying it takes just a day, right? Hiroshima and Nagasaki were destroyed in a day, right? So that's how stock options are for you, my friends. Okay, so that's my story. I've decided from 1 year onwards, I will never go into stock and options. That's it. Doesn't matter what happens. Right? There might be some opportunities, but when I saw some graphs, and I don't know if anyone knows about Microsoft, or maybe we can talk about Intel also as an example. Microsoft stock didn't move for the next 10 years in between, right? And for next 10 years, that stock was at the same price. If you bought a call option, it's like you're losing money, right? So for me, what lesson learned is options and futures like slow poison. It's a time ticking bomb. Just stay away, right? That's my suggestion. The second thing is like profits do not matter. Like there were this 2021 SPAC time, right? Like every company was valued at like, oh, it's 10x multiple, it's 10x revenue, it's cheap, right? let's buy it, right? Anyone remembers that phrase? Right? The same thing happened in the tech bubble of 2000, by the way, right? So history, there's a wonderful saying, history doesn't repeat, but history rhymes, right? So that's what happened, right? Right. And here's a wonderful example. So like people used to say, oh, let's buy it. It's 25 times revenues, right? Let's buy it, right? Scott Neely from CEO of Sun Microsystem wrote this wonderful article, and I just copied and pasted as is. Let's take maybe a minute to read it, and it's pretty explainable. I'm happy to explain, but it's pretty explainable when you buy companies with like 10x will like price to sales. What happens? You're inviting your own doom. So yeah, it's hard. Like if you're buying something at 10 years multiple, right? That means all the revenue is going to come to you as profits in the next 10 years. That's very hard. It's not possible, right? Employees need to be paid, taxes need to be paid, R&D needs to be paid. It's just hard, right? And there's capitalism, right? Every company is going to attack you also, right? So it's not like it's not an easy battle, right? Companies don't get 10 years to survive, right? Right. So just make sure you remember that, right? Don't go with the fact, right? And here's a classic example, right? WeWork, right? Where it was and where it is now, right? It's now, I think, even and Nasdaq is kicking it out of the market also, right? Like out of the index, I'm assuming, right? That's why I read last. These are some of the these are some of the bankruptcies that happened this year, right? So the learning here is profits matter, and business must make profits, right? And they should make cash profits. It's not paper profits. They should make cash profits and create value for the customers. If they are making value and creating profits, they're going to be alive. They're going to sustain, right? And it's very important. So I would encourage everyone to look at the cash profits and only invest in those companies. If it's not making profits, it's a bet. It's a if. I would avoid it, right? Because my goal is not to lose money, and everyone has a different goal, right? So just remember that, right? That's what I'll say. Then there's a myth 4, right? Memes give 10x returns. So I remember I was at OfferUp or at Twitter, right? At OfferUp, I was like, people were buying all this GME stocks, AMC stocks, and what, right? Let's Wall Street bets, all this, right? All this was happening, right? And what happened, right? Today, AMC stock is at the same price, right? $6.1, right? It went like 31, I don't know, right? 51, 100, whatever, right? 450, right? So, and you know what happened in between? They were selling their shares, and they wrote an article where they're saying that, published an article that please don't buy our stock, we are diluting it, right? But still people bought it, right? Because someone wanted to teach hedge funds a lesson, right? That's okay. So hedge funds are much smarter than us. So history has wonderful examples of that nature, where whenever there's a craze or whenever there's a hype, it always lead to some kind of a bad scenario, right? And there are these examples like Ponzi schemes, tulip mania, South Sea bubble, tech bubble, SPACs, FTX, crypto, right? You'll see them coming and coming. So my learning for is like, okay, yeah, it's going good, it's good. We can learn about it, but we don't need to participate in, right? So I would say avoid hype and fad. Let them settle down, and maybe there's a winner, then we can start investing in it, right? But like, don't rush into just buying because it's a new tech or there's something that's happening, right? Let them generate some profits. Let them come. Let them swim out of the ocean, right, for some time, right? This is something new. I also didn't know bonds. We typically think, right? We buy CDs and bonds, right? They're risk-free, correct? Like especially the AAA bonds we buy, they're risk-free, right? Not the CDs, Ashiji, but like these are bonds from like really good companies, right? They are risk-free, we think, right? And last 1 year, like there has been like a 64, like there almost a 60% drop in the bond prices, right? So if you had bought like this this fund, the PIMCO 25-year fund, right? You would be at a 66% loss, right? So bonds can also be risky, right? You have to be careful, right? So again, it depends on the long-term span. If you had a bond which was like a 1 year span, then I think you're fine. But in this case, it was 25-year time horizon bond, and that's why fixed fund is the fixed yield was something I was trying to say. Ashish, I avoid it for that reason. We all like, given all this gambling, given Robinhood, right? We all know markets are very easy to make money, right? Oh, even I'm saying, Chandan, right? I'm saying, oh, buy these quality companies, you should be good for the next 10 years, right? I'm saying that, right? But it's not so easy, right? Here's an example, right? If you look at Nvidia, right? It's gone this like whatever, like 25% CAGR, but you know, there were times where it was 90% down, right? There were times it was 50% down. There were so many drawdowns, right? So did you have that stomach, right? Going back to someone asking, right? It goes down. Do you have that stomach and appetite to share that loss, right? To still be there, right? Market will test you. It will deeply test you. You will not even realize, right? I was tested in the market for 2 years. It was painful. And when I had 50% of my investment in Meta, it went to $90. I bought like 200. I bought it 150. I bought it 80 at 90. I was tested a lot, right? So markets will test you. They'll reward you also, but they will test you. And so, do you have the stomach to go through that, and to go through those drawdowns is very important, right? So it's not easy, as I like. That's why, but having that 10-year horizon will definitely save you. So I don't have the graph right now, but if you had a stock and you hold it for more than 15 years, right, then the probability of making a profit is 100%. Any rolling 15 years for the last from the 100 years, right? That's how it is, right? The profit making is 100%. Period. It's just statistics. Okay. Then this is for people who don't invest in markets, like they keep cash at home or wherever, right? So it's good to maintain an emergency cash or like a 6-month cash, which is perfectly fine. But if everything is in cash, right, you'll see that inflation is eating it, right? So if you had kept the cash, all the cash, which I kept, by the way, for my first 7 years in US, I kept it all cash, by the way. So I basically lost 50% of whatever that percentage based on the number of years. I lost that money. But instead in stocks, you would have made this seven times, right? And the reason I'm sharing that story is like when I came to US in 2012, right? All the companies I wanted to buy, all the companies, trust me, they all at least have done 5x. I was lucky, everything was in Amazon. So luckily, with God grace, it became 50x. That's a wonderful thing. But what I'm trying to say is like just being in the market would have rewarded you. Right? And this is where I would. This is a wonderful quote from Jeff Bezos. Jeff Bezos had a meeting with Warren, right? And he asked, "Why your way is so simple? Why doesn't everyone copy you, right?" And what a wonderful reply, right? Everyone wants to do it. We want to do it at the fastest speed, right? And that's the problem, right? There's a wonderful story of the toy and hare, right? We all have read it in our whatever, in our kindergartens. I don't know when, right? The tortoise wins the race finally, right? And that's what, right? And I think it's very important to get that money slowly because we will start valuing it. Other thing is if we get money fast, we tend to. I don't know if you attended my second presentation, all right. The more the money we get faster, the more haste we have, and then we lose them. We splurge on various things, right? We go on various parties, we spend on lavish items, we do other things. So but when it comes slowly, it comes with hard work, it comes with struggle. We try to preserve it, right? We try to do the right thing, right? So that's what I will say would be my takeaway. So grow slowly but grow wonderfully, and stay humble, right? So again, going back, look for business that are growing. So here's an analogy, right? A person walking with his dog, and markets will keep swinging up and down, right? The dog will keep moving from left side to right side. He will keep oscillating. But if the business is growing, you're good. So just keep monitoring that, and you should be good, right? So that's what I will say. Please remember. Again, I'm repeating my philosophy. I want to avoid loss of capital. That's the most important thing. So the only way I can avoid loss of capital is like buying a business that will never die, right? If the business never dies, hopefully the upside will take care of it, right? And I only want to buy business that are growing. If a business is a constant decline or it's like it's flat, I will not buy it. In the past, I did buy some of them because I didn't understand. I wanted to make sure I'm getting it. But now I think I understand that much more. So it's called GARP, growth. Growth at reasonable prices. That's the common buzzword now. So you want to buy growing companies, but at a reasonable price, right? So that's my strategy. I would say I'm still learning. I'm still making those calls, like those evaluations every day, and then do nothing, right? You do those health checkups, you evaluate, and companies are good, right? They do provide you all the data. You just have to look at it, right? Today I was reading one 10K, and I should have made that to take a snapshot of that, but. So there's a company called Verisign. Anyone heard about company the Verisign?
Yeah, I know the company Verisign, right? Yeah.
So, yeah, it's a wonderful company. Okay, just between us, right? It's a wonderful company, and they have a clause in their 10K where they can increase the price of the the registration by 10% in 4 years out of 6 years. It's like the waste management, right? Waste management that comes to home, right? They can also increase the price, right? Inflation, right? If the government agrees, right? So it's like, and you can't do anything about it, right? If you own a website, you can't do anything. You have to pay for it, right? So again, it's falling. So I'm interested, but it's still not at a price that I would like to buy. But anyways, I'm just trying to say we'll look at that example later. But the more you read the 10K, you'll get some of these anecdotes, and that will help you drive, right? Why that company is gonna grow with time, right? Again, if you forget anything from today, I would say just remember risk is the most important part of it, right? And do not lose money. Don't do gambling. Don't do any speculating. If at all you want to buy a company, and somehow in your judgment call if comes as a if, just wait. Don't buy it. Make sure the facts are correct. Then only end up buying it. Okay. Please remember the quote from Joel Greenblatt, right? I want to buy more of the ones where I can make where I can't lose money on. That's the most important rule he says, right? And he had made 30% CAGR. Just remember that, right? Ashish, I'll come to you. I just want to complete this, right? So again, there are these various things. Safal Vishalji from Vishal Khandelwal is a wonderful investor I follow, and he has this wonderful slide. We think of so many things. We think of risk, we think of cost, we think of time, we think of behavior, we think of so many things, right? Sorry, we think of like, we think of like, okay, how can I make 100%? How can I make 200%? But the most important thing that we control is like our behavior, right? How much time we can give the stock, right? At what price we should buy, right? So that's what we should focus on, right? So with that, the final thoughts, it's a lot of things here, but I would say for me, it's a work in progress. I'm still learning. And the most important thing is take care of health with options and things. Somehow your sleep is hurt, that's what I faced. And so I said I'll never enter a world because my sleep is getting impacted now. And Peter Lynch says, right, trying to predict the direction of the economy or where the interest rates will go or what the Fed will do. It's just based, right? Companies, they are growing. Let's just get in, right? Again, some disclosures, right? Please don't, whatever I said today, especially in terms of companies, don't think of buying them. Like, do your due diligence, right? Again, sscdiver.com is a place where you can go and look at all the resources that I have listed there, right? Take a look. And these are the links to the old presentations. I'll recommend seeing them, right? That we understand the philosophy, right? Understand why we are talking about it right now, right? And any questions, we can talk more, right? Ashish, yeah, go ahead.
Thank you, Jinderji. I was, whenever I look at some quality stock, right? It could be Amazon or any index fund, and I see their performance in the last, let's say 1 year, they've grown by 20%, right? It was like, oh my God, I have missed this opportunity. But should I buy it now? That's the question. So when you're talking about pricing, right? History is not always a predictor of the future. So how do you strike that balance, given that there is an upward trajectory, on many of these quality stocks forever? Do you buy into it and like, okay, it'll keep going up because you've looked at, operating revenue and things like that, and then you are like less worried, I should say, and more confident in investing? Like, what's your mode of thinking there?
I think very good question. So I think we need to do study, Ashishji. So we need to be confident about the future, right? The 10-year future. In case of Amazon, yes, we know the future is wonderful. And the B, we need to, if you remember the first video, right, we need to calculate that floor price we talked about, right? So if you feel, so market is all about like you have 5,000 opportunities, right? And which opportunity is much better for you, right? Where you are confident, right? Where you know it's not gonna be bad, right? So it's all about evaluating them. And the problem is you don't have time. So what I'll recommend you is like, I don't know how much capital you have, but like what you can do is, given you like the company, given you have done some due diligence, right? It might be like, you can just buy one stock, right? That we can monitor it, right? And see how the market is behaving for the next like 1 month, 3 months, 5 months. I understand, right? At the end of the day, after some time, market will really value it the right way, right? And we had opportunities, right? Like if you recall, right? Amazon dropped to like $85, right? right? So we had those opportunities, right? So market will give you those opportunities, right? So if you know how to calculate that fair value, that the value that you think is reasonable, then you may want to go in, right? Now, it can go more lower, that's okay, but you can start putting that incremental capital slowly on that, right? And start seeing how the market is rewarding it, right? Make sense?
Yeah, that makes sense.
And like
I think in the case
I
of
always buy at
single
a day where market falls. That's what I do. I
yeah.
never buy when the market when it increases. That's also one thing I remember. I tell myself.
Yeah, I think in the case of single companies, you can still compute the floor value. It becomes harder with funds, like especially like index funds and things like that,
But
because we
index,
don't know the basis, like the
but
floor
index,
basis
why you
for
need to calculate Ashishji the fair price? So before I answer, Ashish, I want to answer a question, but I want to say something loud and clear. Why do we like to clear get the value of the index fund? Index funds represent the market, right? Which is already the SPE is already out, right? It says 21 times PE, right? And those earnings, right? So 21 times earnings you're paying, right? It's already out there, right? Why would you like to value it?
Well, the question was like, let's say if I take VOO, right? Should I buy it today versus, let's say, when the price drops 5% more? Should I wait or not? Because
So so let's say there is a sweater you like, right? And you like it $100, right? And today it is $95. Would you buy it or not, right? You would buy it, right? So it's like that. You should buy it. But like in terms of how much percentage or how much capital put, that, I think that's something based on your risk profile. You can start. I would
got it.
say I would say depending upon your confidence that it can go lower, you can start chipping in slowly. Make sense?
I think that makes sense. I think I'm also most comfortable with the dollar cost averaging over time.
Yeah, don't I would say don't put in all your capital. So the
Yeah.
way I think, and we can do another talk on how to build portfolios, but the way I would do it, I will do slowly. And the reason I want to buy one stock at least is so it's on my mind that I want to look at it. If you don't buy it, it will go out of your mind, right?
Right.
Uh, uh, Again, like before we take another question, I want to make sure, like, again, the idea here is to build a team, build a sounding board, and we all discuss further, right? And my idea is to help everyone. So if you ask questions, then only I can help you. So yes, I would encourage everyone to ask questions and definitely use the website, definitely play with it, and that way we can make it better and make sure our process is, like, there, right? That way, we can. The idea is, like, given a stock, we should be able to figure out in 10 minutes should we even spend time reading the 10K or not. Make sense? So yeah, Rahulji, go ahead. You had a question. Rahulji?
I think you're on mute, Rahul.
Oh, sorry. Can you hear me now? Sorry, I was on mute.
Yeah.
Yeah, okay. So my question was regarding the diversification, right? I don't know if you already had the session on it. So let's say if I do my research, I know like the 10 years down the road, X company will give me, returns. But then, like, how do I balance my portfolio in that case? Like, if I feel strongly about like a company, should I put in everything in there versus, like, how to diversify my basically portfolio? Um,
Very good question, Rahulji. We'll try to cover it in
mhm,
one of the sessions, like portfolio construction. But here's my quick take.
mhm,
Uh, don't put all. That's one, because there's a reason why it's dropping, right? There's a reason why it's going to that lower price, right? Even though it's quality, right? There's a reason, right? So as long as you understand, so the way you should ask yourself the question is, like, why people are selling it? Why is it dropping? If you can answer that question and understand the reason why it's dropping, then it might be better. But, like, again, we are all not. I'm not Warren Buffett, so my strategy is not to put more than 10% of my capital, regardless. So I have a
mhm.
limit. So I start with the 1%, right? And depending upon my calculations and confidence, I make it go further.
Okay, so basically you're saying, like, if you have 10% set as a fund to invest, and you won't put more than 1% of what you have in that.
Exactly.
Yeah.
Exactly. Whatever is, let's say, whatever you define as your
Mhm,
$100,
mhm.
like, so my goal is to keep a list of 20 stocks every time.
I
I
see.
have more, so you can look at my holdings on the website, right? I have more, but like my top 7 stocks have like 80%, like 70, 80% of my capital.
Mhm. Got it.
So again, it depends on your confidence. Then there's, so I call it like, one is like confidence scenario where I know it, and the second is like lab test where I don't know, I'm reading, so I want to add a little bit more when I know its price is dropping now. Make sense?
Yeah, makes sense.
A laboratory test, right? Something like that. Right? So let's talk about Verisign, and we can take another example, right? I'm talking Verisign because I'm evaluating it right now, right? It's dropping. And so if you look at my recommendation, $140, right? Makes sense, right? And I'm not gonna go with the I'm saying that that's the right recommendation. Actually, it's much better than that. So I'm just gonna show this quick example, right? So if you look at it, right, like the cash flow operating has grown at 4% CAGR for the last 9 years. Correct? Is that correct? Right? And I don't know if you know, like Verisign is buying its stock every year. And so the number of shares are dropping by 4%, right? It's compounding, right? So basically, overall, the stock price will go by 8%. Does it make sense? Why? Everyone, like 5 plus 4, 9, sorry, 9%. Does it make sense? Why? So there's a 9% growth rate, right? Inherently, right? And if you look at, let's say this, right? So here's why I'm trying to tell you, right? So this is the cash flow they are making, right? This is the cash flow they are making, right? And look at all that cash flow is going in buying shares. Do you see that? They are just consecutively buying shares and share, right? So their stock count went from 0.17 to 0.11. So they are like a. Is everyone able to see those numbers? Sorry, I'm just trying to increase it. Is it good?
When does this happen, Chandanji?
Yeah, I'm just trying to say, take an example of a stock where the company knows its underwriters is buying its shares every year. Right?
Why would they do that?
You need to read a 10K for that. But what I'm just trying to tell an example where you can figure out the future growth of the company just by looking at what's happening, right? So they are earning 4% every year, and they are taking away the stock, right? So stock is dropped. They are removing the stock from the market. So basically, you can have like a nice and the way, so they are guaranteed to generate 5% return growth every year. And if they drop the share count by 4%, that means you're gonna get a 9% CAGR regardless. Now the only thing is, when do you buy? That's a separate question we talk about, right? Does that make sense to everyone?
Yes.
So all the cash flow is going in buying capital, buying stocks. That's it. And their profit margins are huge. It's like 60%. Do you see that? And they have very low capex. They don't need any capex. If you know Verisign, you'll know, understand why it doesn't need any capex. So everything is like free cash flow. And so that's why my analysis doesn't come at 140, it should like come at 180 with 190, which is the current price, because if you do 4% compounding, it will come to the median price. Anyways, so that's something I wanted to share. Again, if you look at this, like look at this company, right? See, it's growing revenues. Do you see that? It's just growing revenues, right? Cash flows are also going similarly, right? So those are the companies you want to look at, right? Where the share counts is dropping and the revenue is increasing. So your pie is increasing every year, right? They don't pay any dividends, by the way, so which is actually good for you, right? Because when the company pays you dividends, the companies pay the company already paid taxes, we also pay taxes, right? So it's double taxes, right? So but if the $1 stays with them, it grows, right? So it's much better for them to buy for us, right? And given market is giving them 30 times P, if they produce $1, we get $3 in return. Make sense? Because it's a 30 P, right? Versus for us, that $1, it depends on how we find other investments. Our $1 may not even go to $1.5. Is everyone understanding the math here?
Yeah.
Yeah.
I mean, it's very interesting that Verisign it didn't really take a huge dip during COVID compared to like other companies.
Now people are selling it because there are other opportunities. So, but like for me, because I don't want to lose money, this is a good investment. I know it's working. So again, I'm not investing out, but I'm just trying to put in slowly and steadily. That makes sense? I wanted to fall more. The last I bought was at $160 and $180. That's when I bought it in good amounts.
Mhm.
They are in the internet infrastructure, right? So they did actually pretty well in the.
It's a monopoly. It's a monopoly. No one can.
Monopoly, yeah. No one can basically.
They are the only ones provider. That's it.
Correct.
Again, those are the companies I want to look for, right? No one can distract. Like it's I can, and they have a clause where they can grow by 5% in between in 5% within 4 years, for every 4 year within in a group of 6 years, in a range of 6 years. So wonderful, right? So if you look at by the way, I built this tool that will be like a paid tool for all of us, wherein you can give a list of stocks. So let me just give an example, right? Sorry. Oh, come on. So now related companies, fair values. So this may not. Oh, there's a lot of companies. Okay, but like I will, like, you can give a list and it can get you those portfolio things. And here's what I wanted to tell you. So essentially, like the idea is to see what will be your portfolio be when you buy a lot of companies, right? So, and you want to measure your ROC of your portfolio, you want to measure ROC of your portfolio. That's what I do, right? So you give a list of stocks and I calculate that for us, right? Okay, I'm going to pause here. Does the Verisign example make sense? We can take Starbucks, but I think the person who wanted to do is left, I guess. Is that correct? Does the Verisign example make sense to everyone? Okay, I'm gonna stop the recording. Again, just to repeat, again, the goal is to help you. And the only way I can help you is like if you ask questions, you participate in our WeChat group, right? So, and use the website, right? So thank you again for coming, and I'm stopping the recording, but we can continue to talk for another 5 minutes.